Super microcomputer, SMCI, is back in the headlines, not just because GPUs are cool, but because the business of hauling, cooling, and powering those GPUs has become a high-stakes thriller. One day you're the darling of the data center boom, the next, an analyst cuts the target and the stock takes a bow. What Supermicro actually does, and why that matters. Supermicrocomputer isn't a chip company. It's not the headline maker that makes the neural net smarter. Instead, Supermicro designs and manufactures the high-performance, liquid-cooled servers and storage systems that host advanced GPUs and accelerators inside AI data centers. In plain speak, if NVIDIA builds the brains, the GPUs, Supermicro builds the skull, the cooling system, the power feed, and the chassis that keep those brains happy and online. Supermicro's engineering is tuned around dense, power-hungry platforms, often built specifically to optimize for NVIDIA's latest rack-scale GPU platforms. Think of NVIDIA as the chef making a Michelin meal and Supermicro as the kitchen designer who ensures the ovens, ventilation, and bench space exist so the chef can crank out courses at scale. You need both to run a banquet. The supply chain reaction, chip servers racks. Those NVIDIA GPUs are manufactured by Taiwan Semiconductor Manufacturing Company, TSMC, the world's preeminent foundry. When TSMC signals big demand, and commits to massive capex to expand capacity, it's basically the upstream confirmation that more chips will be available. More chips equals more racks, and more racks equals more Supermicro boxes and integration work. TSMC's increased 2026 capital spending plans and bullish guidance helped spark a recent broad rally in chip, equipment, and server stocks, because the foundry's outlook is the closest thing the market has to a proof point that the AI spending cycle keeps accelerating. If TSMC says, "We'll build more factories," it's like a stadium ordering more seats. Suppliers downstream suddenly get calls to deliver more bleachers, lights, and plumbing. Why Supermicro was a market favorite, the easy part. During the first, messy, euphoric phases of the AI infrastructure boom, investors were happy to reward any company attached to the train. Supermicro's positioning, early support for liquid-cooled NVIDIA platforms, quick customization, and a nimble U.S. manufacturing footprint, made it an obvious beneficiary. For clients who needed fast, dense, and efficient deployments tuned to the latest NVIDIA platforms, Supermicro often outpaced larger incumbents in responsiveness and customization. That gave it preferred vendor status for many cloud and specialized AI operators, and that kind of reputation can rapidly translate into juicy revenue growth when the chip orders arrive. It's like being the local contractor who can turn a blueprint into a concert stage in half the time of the big national firm. When demand spikes, customers call the faster crew. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. The maturing cycle, growth isn't enough anymore. Here's the uncomfortable pivot, the market has started asking harder questions. Growth alone, headline revenue increases and big backlog figures, is no longer sufficient for the most sophisticated investors. They want to see whether growth translates into sustainable profits, predictable cash flow, and, ideally, rising margins. For a capital-intensive, manufacturing-heavy business like Supermicro, that's a different playbook than being the nimble growth darling. As competition intensifies and large contracts are pursued at scale, the margin dynamics can flip from expansion into compression. Investors are asking, can Supermicro convert demand into returns that are durable, or is it sacrificing margins to chase share? It's the difference between selling a lot of pizza at break-even and selling fewer pies at delightful margins. Growth is fun, profits pay your electricity bill. Goldman Sachs, the downgrade that didn't like the encore. This is the moment that ratcheted up the selling pressure. Goldman Sachs initiated coverage or moved to a sell rating on Supermicro, cutting the price target to $26 from $34. The analyst, Catherine Murphy, pointed to deteriorating profitability, execution risk, and limited upside relative to the company's current valuation as the main concerns. The market took notice. Shares fell more than 6% in the immediate reaction, wiping out some early optimism and amplifying the fragile tone around the name. When a major house like Goldman downgrades a prominent AI infrastructure stock, it signals a shift in the narrative, from "buy the sector" to "pick carefully." Imagine your favorite band announcing their new tour dates and then the most respected critic in town writes a review titled, "Great sound, bad cash management." Ticket buyers get nervous. Margin compression, the real headache. Goldman didn't pull that downgrade out of thin air. The numbers show a meaningful deterioration on the profitability front. Supermicro's non-GAAP gross margin recently printed around 9.5%, a significant decline from healthier levels in past years. That kind of compression matters because it means each incremental dollar of revenue generates much less profit than before, and in a hardware business, gross margins are the first line of defense for overall profitability. Analysts argue that to keep winning large volume deals, management has accepted thinner pricing, and the result is structural pressure on margins. If you sell lots of widgets but each one gives you less profit, your top-line growth can look lovely on a chart while your bank balance is not keeping pace. Note this as well. Do you want peace at heart? John 1:29 tells us that, "The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters." Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: "I stayed until the end." Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.